This is how to start day trading in 2026. But I want to be clear from the start. This is not type of the get fast rich videos. This is a complete guide how to create a mechanical system so you don't need to switch a strategy anymore. Understanding the liquidity concept from 0 to 100 and how to start looking at the market in the way that finally makes sense. I want to say this early in video so we can use the video in the right way. This is not something you rush through. The first time you watch it, you will understand what I'm saying. The second time, you will understand why. And that's when things being start to click. For those who don't know, my name is Ebol. I'm trading for 6 years, and in this video, I will going to teach the exact framework that I'm using and able to make more than 6 figures from prop frames and in trading. And I'm going to teach you the same framework that my student used, believe right away, because this is where most traders go wrong. Most traders think they are not profitable because they don't have a perfect strategy or a good strategy, but this is completely wrong. In fact, the strategy is the last thing that fixes a trader. The real issue is this: you don't understand why price move, you don't know where liquidity sit, and because of that, every trade feels like a guess. And that's why you overtrade, that's why you revenge trade, that's why you're switching strategy every week. Not because you are bad, but because no one show you how trading work as a skill. So I need to be honest with you. This video will not going to make you profitable today. It won't make you rich in this month. What it will do is give you a clear framework so you stop wasting time doing random setups and start build a real consistency. If you're watching this, it's the first month of 2026 and it's the perfect time to reset and not with another strategy, with better way of thinking. So don't rush it and focus on understanding, not catching a trade. And let's break it down. Well, welcome to the first lesson. In this lesson, we're going to talk about tree candle confirmation. So what is tree candle confirmation? Listen, tree candle confirmation, it's going to be a topic once you understand it, the market structure and the liquidity, it's going to be so much easier for you. So it's one of the most important piece of price action towards understanding the liquidity and the market structure. So that's going to be so important. So the tree candle confirmation is actually swing high and swing lows. Okay. But in this video, I'm going to dive deep on that how you can understand them. And you should be able to train your eyes. So once you open the chart, you can see the tree candle confirmation fast as possible, right? Under 5 seconds, you can easily find them. Because if you want to find the market structure or liquidity, you shouldn't start to take, 5 minutes, 6 minutes to draw a line and pretty much think, drink your cup of coffee, and then start to identify those. No, it should be fast as possible, right? Because the strategy you're about to learn is based on live market data, and you should be fast. So it's not going to be scalping, but you should put as much as time, the less time you can in the chart to analyze and just draw your liquidity and wait for opportunity. Because the more time you spend on the chart, the more overthink you're going to get. And the more overthink you're going to get, guess what? You're going to pretty much get confused and you're going to fall for the emotion trap. But anyway, so let's talk about the tree candle confirmation. So as the name suggests, a tree candle formation or confirmation requires a tree candle. Two key things to remember: that is, the second candle will always be the highest and the lowest candle out of the third, right? And the third and the first one. And the colors of the candles do not matter. It's not important for us. The only thing that important is just going to be the wick or the shadow of the candle, which the second one should be higher than the first and the third one. So let me show you an example. Take a look. We're going to talk about the swing high. So we have a tree candle here, right? So the first one, okay, and the third one, they have lower shadow than the second one. So the second one should have higher than the first and the third one. So this is going to be a swing high, a tree candle confirmation. And in the swing low, okay, 1, 2, 3, right? So the second one should have lower, okay, should have lower than the first and the third one. Here, this is my mistake. I write the swing high. It's going to be swing low. So the swing high and the swing low should be tree candle confirmation. How are you going to find a tree candle confirmation? Tree candles, okay, which the second week should be higher than the first and the third one. Okay, as you can see in the diagram, candle number 2 is the highest candle of the 3 and 1 for swing high and the lowest candle of the 3 and 1 for swing low. Okay, now let me show you some example here. So take a look. 1, 2, 3, right? There's a tree candle, and the second one have the highest shadow than the first and third one. So this is going to be a swing high. 1, 2, 3. So the second candle have the highest shadow than the first and the third one. 1, 2, 3. The second candle have the highest shadow from the second and the pretty much The second candle have the highest shadow from the first and the third one. 1, 2, 3. The second candle have the highest shadow from the first and the third one, and the same like this, right? Now let me show you one more example on the swing highs. Take a look. 1, 2, 3. The second candle is higher. 1, 2, 3. The second candle is higher. 1, 2, 3. The second candle is higher, right? So you can pause the video and you can dive into the deep example, but I'm gonna also dive into the chart and I'm gonna give you some assignment to do so you can master this fast as possible and you can train your eyes to identify them less than 5 seconds. So let's go to the swing low. Now same for the swing low. 1, 2, 3. See, the second candle have the highest shadow from the first and the third one. Okay, 1, 2, 3. The second candle have the highest shadow, then the lowest shadow from the first and the third one. Here, 1, 2, 3. The second candle have the lowest shadow from the first and the third one. Okay, here's a deep example. You can pause the video and you can dive deep to the example. See, 1, 2, 3. The second is the lower, right? 1, 2, 3. The second is the lower. 1, 2, 3. The second is the lower. So these are going to be swing low. Now, you understand the three candle confirmation and swing highs and swing lows. For sure, in the next lesson, you're going to understand why they are so important in the market structure and the liquidity side. So let's dive into some example here in the chart. So I'm going to open this right here. Let's go to the 15-minute, 5-minute time frame. Doesn't matter. I think the 15-minute time frame is going to make more sense. The time frame is not important. The market is fractal, which I'm going to talk about this also. So take a look. Now, I'm going to first identify a swing high and swing lows here so you can see how I identified in the live chart. And in the next example, I'm going to give you a time as an assignment so you can do it. So take a look. First, I'm going to start with the swing high. I'm going to look for the swing high inside the Asia session, for example, because we have a rectangle here, so we have a clear area. So take a look. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, inside the Asia. So also we can take this one, and we can also take this one. So take a look. Each candle that I took, 1, 2, 3. The second candle shadow is higher than the first and the third one. Okay, see, 1, 2, 3. Okay, the second candle is higher. So EBOL, is this a three candle confirmation? Let's see, is this a three candle confirmation? No, because the first and the third candle shadow is not lower than the second one, and the second one is not higher than the first and the third one. EBOL, is the candle colors matter? No, it's not matter. It's not important. Even the second candle is going to be bearish candle, and you're looking for swing high. If the wick is the higher than the first and the third one, cool, man, you're good. So the colors not matter. So let's go with the swing low. I'm going to identify the swing low with the new color. Take a look. 1, 2, 3. No, this is not. 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12. Right. So take a look. How did I choose this? 1, 2, 3. The second is the lower shadow, the first and the third one. Okay. 1, 2, 3. The second have the lower shadow than the first and the third one. Okay. This wasn't. Why? Because take a look. The third candle have the lower shadow. I mean the lower pretty much. The second one is not lower than the first and the third one. Okay. 1, 2, 3. Swing low. 1, 2, 3. Swing low. 1, 2, 3. Swing low. Is this a three candle confirmation? No. Here you should be so careful. See? 1, 2, 3. No. Okay? The second one's not higher. 1, 2, 3. It's going to be the first one. So it's not. The second one is not higher. So lower, sorry. So this is the swing low. So if you take a look, I just identified in less than 5 seconds. Okay? And I didn't train before the call. I can do it any time that you want. The reason is I train my eyes. Now, because I train my eyes, for the swing high and swing low, this is going to help you. Once you train your eye, you can easily understand the market structure so fast once you open the high time frame. And once you dive into the liquidity, if you want to identify the liquidity, which we're going to talk about that also in the next sessions, it's going to help you a lot. So now let's do some assignment and practice together, right? So let's dive into this one. Here, okay, what I want to do, first we're going to look for the swing high. I want you to pause the video and just identify the swing high. And once you identify it, play it and see is the swing high that you choose and I choose, it's the match or not, and look for your mistake. So you pause that, cool, you find it, let's go with it. So I'm going to start with the swing high inside of these. So I have one here, one here. Let me just make the color blue. one here, 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 one here. So yeah, that's it. Take a look. 1, 2, 3. The second is higher. The second is higher. 1, 2, 3. 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 The second is higher. Higher here, and higher here, and higher here. Now let's go with the swing low. Pause the video and look for the swing low. So now let's go with the swing lows. Okay, 1, 2, 3. Here, 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 and here, 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 for sure here, here, and here. So take a look. Maybe you have some question here, so I'm going to answer it right now. So 1, 2, 3, the second one is lower. 1, 2, 3, the second one is not lower. So 1, 2, 3, the second one is the lower. 1, 2, 3, the second one is lower. 1, 2, 3, the second one is lower. 1, 2, 3, the second one is not lower. The third candle is the highest one, right? The lowest one. I'm sorry. 1, 2, 3. So you see, I made a mistake here. Yeah, I made a mistake. I didn't saw this. So see, 1, 2, 3. This is not a tree candle confirmation. Okay. 1, 2, 3. The tree candle confirmation. 1, 2, 3. 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 The second one is lower. And 1, 2, 3. The second one is lower. This is not a tree candle confirmation. Why? 1, 2, 3. The second one is not lower than the first and the third one. So yeah, this is how you can find tree candle confirmation. If you want to do more practice, I recommend to just go to the daily time frame first and draw a rectangle or area for yourself and start and look for the swing high and swing lows. Now in the next video, we're going to talk about the market structure. Now I'm going to give you a full explanation how I look for the market structure in the market. Cheers. Well, welcome to lesson number 2, which in this lesson we're going to talk about the market structure. Your point of view to the market structure is going to be completely get shift. So take this lesson so seriously. This lesson your mind gonna get open. Okay. So let's start with what is the market structure. Market structure is completely, I can say, is often misunderstood by people, because when we say the market structure is bullish, that doesn't mean the future market structure going to be bullish or price is still going to continue to be bullish. When we say the market structure is bullish, that means right now the price action of the price is bullish. So that the reason of this, that because market is not 100%, and pretty much the market structure, it's a snapshot of the present condition, right? And the strategy you're going to learn, okay, I'm going to teach you here. And also if you want to join to the, let's say, the liquidity inducement club or one-on-one mentorship, the strategy you're going to learn is a mechanical, and it's based on the live market data. So what's that mean? That means we are not going to do anything with the past. The past happened, finished. We're going to take a look to, let's say, this week liquidity, today point of interest, this week point of interest, depending on the style that you want to walk, day trade, swing trade. So for us, the live data matter. That reason, maybe today I'm gonna say I'm bullish in the market in the Euro USD. Tomorrow you're gonna say I'm gonna say I'm bearish in the market, and I'm in the bearish market structure in the Euro USD, right? So that reason market is not 100%, and we should be flexible. Now, there is a beautiful quote from Bruce Lee. It says, "Empty your mind, be formless, shapeless, like water. You put water into a cup, it became the cup. And you put water into a bottle, it became the bottle. And water can flow or it can crash. So be water. It's the exact example that we need. Just like water takes the shape of the container, a trader must stop the market's flow. So the market is like a massive ocean, and we want to pretty much not fight with the market. We want to move with it. So we should be like water. We should be flexible, right? So let's get started with the market structure. So the market structure, the way that I'm looking for the market structure is the basic market structure. So we have one bullish market structure, which I'm going to teach you right now. What is a bullish market structure price action? A basic bullish market structure price action. So in an uptrend market, we will see a series of the higher highs and the higher lows. Okay, the lows will be protected, and the price will try to create a higher highs. When the price creates a higher high, it's mean there has been an upward structural break also known as a break of market structure. Okay, so in a simple language, in a bullish market structure, the lows, the swing lows, gonna get respected. I'm gonna talk about why swing lows. Okay, the low is gonna get respected, and the high is gonna get taken out. So this is the bullish market structure. In the bullish market structure, price is gonna go up, right? The low is gonna get respected, and the high is gonna get taken out. So we call this uptrend, right? Now, once price break the highs, this action, it's mean break of structure or break of market structure or anything you can call it, or BOS, right? So the low is going to get respected, and you're going to see the highs is getting break, right? Now, if the price is an uptrend market decide to break a low in the correct context, it's mean there will be a trend reversal in case from uptrend to downtrend. So in a bullish market structure, we are expecting to price respect the lows and take out the highs, right? But what if price didn't respect the low and break it and create that BOS or break of market structure from the low, not from the high in a bullish market structure? So that's mean trend reverse. We call this shift in trend. That's mean we went from a bullish market structure to the bearish market structure. Now, this is so important. And the same thing going to be in the bearish market structure. In a downtrend market, we will see a series of lower highs and lower lows. The highs will be protected. The highs will be protected, and the price will try to create a lower lows. So in the bearish market structure, you can see the highs going to get protected. Okay, price going to respect the highs, and price going to take out the lows and create a break of market structure from the lows. So pretty much in the bearish market structure, we're expecting the highs get respected and the lows get taken out, right? So, but what if the high get taken out here? While we was expecting the bearish market structure price respect the high, but what if high get taken out? Again, shift in trend. That's mean you went from a downtrend to the uptrend. So this opposite break of market structure here in the bearish market structure or even a bullish market structure, it's mean shift in trend. Okay, shift in trend. That reason you should be update. So if you see this shift in trend, you're going to say, for example, yesterday was in a bearish market structure, but today you see price take out this high. Yesterday you was bearish, today you are bullish. That's the reason you should move on with the ocean, like water. Now, there is one important thing. In an uptrend situation, until a new higher high is created, we can confirm our higher low. Just as in a downtrend situation, we can confirm our lower high until a lower low is created. So that's mean you can say this is my lower high until this lower low gets created, until price take this up and pretty much create the lower low. So this lower high gonna get confirmed once the lower low gets created. Okay, that's mean if price didn't take this low yet, didn't create a break of market structure yet, you can say this is my lower high. Okay, now let me show you some example about the bullish market structure. So take a look. This is the low. Okay, let's say this is the high and low. Price come down, create the low and high. When this low get confirmed, once price create the break of market structure and create this new higher high. Again, low, higher high. Price come down, higher low, okay? This is the bullish market structure. The low is getting respected, right? And price go up, okay? Again, see, higher low, higher high, okay? This get confirmed. Once this higher low get confirmed, once price create a new higher high. Again, come down, respect the higher low, okay? Go up, take out the higher high. Cool, this is a new higher low, okay? When this new higher low gonna get confirmed? Once the new higher high get formed. Now, here we are expecting to price respect this. We are expecting the price to respect this and take the higher high. But price didn't. The market is not 100%. Didn't create the break of market structure here. So here means you went from a bullish market structure to the bearish market structure. This is called shift in trend, right? So you was bullish here, now you are bearish. Now let's see some more example in the bearish market structure. So take a look. You are in the bearish market structure here because the highs getting respected, the lows get taken out, right? So price respecting the highs, take out the lows. Respecting the highs, take out the lows, right? Respecting the high, take out the lows. Respecting the high, take out the low. We are still expecting the price respect this lower high and take out the lower low. But what price did? Price didn't. Price take out, create a break of market structure here. So that's mean you went from a downtrend to uptrend. Here, shift in trend happened. So you should understand here, shift in trend happened. And you are right now in the bullish market structure. So if you are here, you're going to say, I'm in a bullish market structure here. But if you are here in the market, you're going to say, I'm still in the bearish market structure. So now let's dive into the trick and the confirmation about the market structure. Now that you understand the trick and the formation, confirmation, it's time to learn one of the important ways we use it. I told you in the first session, in the first lesson, that tree candle confirmation. We're going to use it for the market structure and the liquidity. This is for the market structure. Okay, so now you may recall from the lesson number one that the lesson that we talk about the candle formation, that they are also known as a swing high and swing lows. That is because once we blend it with the market structure, they will now become pretty much what we call as a swing point. Okay, so I'm going to show you the exact example here. Take a look. So this was the bullish market structure, right? This was the low, high, low, high, low, high. See, all of these low, high here in the market, they are tree candle confirmation, which we call them swing point, or okay, swing high, swing low. So the swing high is tree candle confirmation to the upside. The swing low is tree candle confirmation to this downside. So the both of this, we call them swing point. Okay, so see, all of this, the high and lows are tree candle confirmation, all of them. Okay, take a look here. We are in the bearish market structure. Take a look to the high. 1, 2, 3. The second one is higher. 1, 2, 3. The second one is lower. 1, 2, 3. The second one is higher. So swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low. Okay, but imagine once you train your eye, once you open the chart, and instead of drawing the market structure like this to you to understand, what is your market structure? You're gonna just follow the swing highs, and that's it. That's it. You easily find your market structure in less than 5 seconds. So now let's talk about the break of market structure, that maybe you guys have some question on this. You might also notice that when price create a break of market structure, it's breaking above or below the tree candle formation and not protecting them. There are swing points. So for a valid break of market structure, price needs to break a tree candle formation. So another question that you may ask is, Ebol, the break of market structure should be with the body close or with the wick or shadow close? So for a high probability break, we prefer to see a body close above the swing high or a body close below the swing low. But if you see the break of market structure with the wick close above the swing high or below the swing low, that is the BOS manipulation. So BOS manipulation, it's going to help you to understand, to give you the quick signal where price is going to reverse price going to shift and trend, what is the current structure is valid or not. It's worked, all of these concepts work in the all time frames because the market is fractal. Especially for the scalpers, the BOS manipulation, it's the concept of BOS manipulation going to help them a lot to understand the low time frame or the live price action of the data. Is price going to continue moving or price going to go up and manipulate? Especially when the day trading is going to be so helpful, which this is a topic that I'm covering in the VIP group, which you can join and pretty much you'll learn it. But let's get back to the chart and do some practices about the market structure that we learned, right? So take a look here. Here we are in a bullish market structure. The low is getting respected, the high is getting taken out, right? So the low is getting respected. See, the lows get respected, the highs get taken out, right? Here, price didn't respect this low. Shift and trend happened here, right? Again, we was expecting this high. Again, 2 shift and trend happen here. Here you get 2 shift and trend. Now with the BOS manipulation here, you can easily understand that price going to reverse with the concept of that. So here again, you are in the bullish market structure. You're expecting that price respect this low. But what you can see, price take this. So now you was in the bullish market structure. Now you're on the bearish. Okay, you're on the bearish, retracement, bearish. Okay, and pretty much expansion, which I'm going to talk about. What is the expansion, retracement, and a fractal nature? I'm going to talk about that. But if you want to look for the market structure, you don't need to start and draw like this. This was just an example, right? The only thing you need to do is open the chart, look for the last major break of market structure. In this case, this one. It's a bearish market structure with the body close. You are in the bearish market structure. Maybe tomorrow you're going to come back and see price, the last major break of market structure, this. So then, yes, your market structure is bullish. That reason we should be flexible. If you want to look for the market structure, look for the last major structure. Now, let's talk about the fractal nature of the market structure, okay, which the expansion and the retracement. So Expansion is the phase in which the structure progresses towards its the main direction. So if you're on the bearish market structure, if you remember, we told that this is the bearish market structure. So these main move in the bearish market structure, these main move here, it's going to be expansion. And these counter trend move going to be retracement. See, bearish move, these are the expansion, these are retracement. Expansion, retracement. And in the bullish market structure, expansion, retracement, expansion, retracement, expansion, retracement. So now let me show you one example here. Take a look. This is the bearish market structure, right? The high is getting protected, the low is getting taken out, right? Expansion, okay, the main move, retracement. Expansion, retracement. Now, this high, take this low right now. I mean, here, let's say, this is going to be expansion. This is not going to be expansion, retracement. Why? Because this high didn't take this low yet. So this is going to be full, this move going to be full expansion. Now, let's talk about the fractal nature of the market structure. Now we must understand that the higher time frame and lower time frame, it's same because market is fractal. Let's say the black line is the daily time frame and the blue line is the 1 hour time frame. So in the daily time frame, you have expansion, retracement, expansion. Now, if you drop down to the 1 hour time frame, you're going to see inside the expansion, a daily expansion in a 1 hour time frame, you're going to see a bullish market structure. Expansion, retracement, expansion, retracement. And once expansion daily time frame finished and the retracement going to get a start in daily time frame, you're going to get a signal in the low time frame first. What is that signal? Shift in trend from bullish market structure to the bearish market structure. So this shift in trend here going to give you the signal in the daily time frame expansion finish. Now in the retracement going to start. Now in the retracement phase in the daily time frame, in the 1 hour time frame, you're going to see a bearish, if shift in trend after shift in trend, you're going to see expansion, retracement, expansion, a bearish market structure. Now you're going to get the signal of the shift in trend once the new expansion start. So once you get the shift in trend here in the 1 hour time frame, you are going to understand that, yes, the expansion of the daily is start. Okay, so for sure you can have an entry here and you can easily catch the higher expansion of the daily and the low time frame, which I'm going to teach you. And you can easily with this signal to understand that price start expansion. Now let me show you one example in here, and I'm going to show you one example in the chart. So take a look here. This is a daily time frame. This is the 1 hour time frame. Okay. So expansion, retracement, expansion. Take a look. In the expansion phase, which is going to be from here to here, you're going to see expansion, retracement, expansion, retracement, expansion, retracement, expansion, retracement, expansion, shift in trend. So this shift in trend here means the retracement in the daily time frame going to get a start, right? So now in the retracement first from here to here, okay, expansion, retracement, expansion, retracement, okay, expansion, retracement, expansion, retracement, expansion, retracement. Here you get the shift in trend. Okay, so here there is a signal that yes, you went from a bullish market structure to the bearish market structure, and the new expansion phase you're going to see expansion, retracement, expansion, retracement, expansion, retracement, expansion, retracement, and to the downside. Let me show you one clean example in the, let's say here the GBP/USD, right? Let's talk about one example right here. So let's say this is the expansion, retracement, expansion, right? I'm going to go to the 1 hour time frame. This is the daily time frame. Take a look. In the daily expansion, what do you have? Inside, you have a bearish market structure. See? Right from here. Expansion. Okay, let me just draw with this one. Expansion, retracement, expansion, retracement, expansion, retracement, expansion, retracement, expansion, shift in trend. Shift in trend right here. Now from here, giving you the signal that retracement of the daily structure start. Expansion, retracement, expansion, retracement, expansion, retracement, expansion, retracement. Here, shift in trend. That's mean the new expansion start. Take a look. Expansion, retracement, expansion, retracement, expansion, retracement. That's it. And for sure, you get the shift in trend here. See, again, you get the shift in trend here, so you can understand the daily the expansion start, the new expansion of the daily start. And you can keep continue like this. So again, if you want to look for the basic market structure, one of the most important thing you should do is in the daily time frame, Open the chart. You don't need to draw like this, okay? Just look for the last major break of market structure. If the last major break of market structure is bullish, you're bullish. It's bearish, you're bearish. And if it's the closest with the week, there's a previous manipulation that you should be so careful on that. The most of the time it's going to be happen. So, yep, that's it. Let's go to the lesson number 3, which is going to be liquidity. That's it. Well, welcome to the lesson number 3, which in this lesson we're going to talk about the liquidity. What is the liquidity? I'm going to show you the different type of the liquidity, and for sure we're going to do some practice at the end of the chart. So first let's start what is the liquidity. So in this lesson we are going to go through the liquidity. This topic is going to be one of the most important part of the strategy because the forex market is the most liquid market in the world with daily volume of $6.6 trillion, right? Liquidity is what drives the market. So it's not absolute necessity that we understand very large amount of the liquidity is resting in the market, as this is what makes this strategy so powerful. This concept you're going to learn so powerful and so consistent. So let's go through it one by one. So the first one is the swing high. So first and the second purpose of the trick and the candle formation, we had the structure. First, I teach you how to find with the swing points, how we can find the structure. Now it's going to be a liquidity. Listen up. Above every swing high that has not yet been broken, there will be a buy side liquidity resting above in the form of the buy stop. So that's mean the retail traders, they expect that they're going to put the buy stop order above each swing high, especially the high time frame, and they believe if the price break that high, so the market going to be bullish. So pretty much they looking for the buy stop. They're going to put the buy stop a little bit above this area, somewhere around here, and they expecting once price break this, okay, price activate their order, they're going to set the TP here, depending on their strategy, and the stop loss here, and they expect the price go up. But what's going to be happen? It's going to price going to give them a little bit profit, and the reason of the profit is just make sure that everyone is in, and after that price going to reverse. Right now, the same thing for the swing low. If you take a look about below every swing low that has not yet been broken, there will be a sell side liquidity resting below in the form of the sell stop. Again, because the retail trader think they're gonna put the sell stop here, okay, and they think if price break this area, okay, they're gonna be bearish, so they're gonna look for the take profit somewhere around here and the stop loss for sure here. And what's gonna be happen? Price gonna activate them, give them a little bit profit to make sure everyone is in. Then price gonna reverse and the stop loss going to be hit. Pretty much this form, it's more like the stop hunt, which I'm going to teach you in the next 2 lessons. Now let me show you some chart example. So if you take a look here, right, the green is the buy side liquidity and the red is the sell side liquidity. So this is a swing high that the traders put their buy stop order here. What price did? Price can activate them, give them a little bit profit, and then start to reverse. Now again, look at the sell stop. You can pause the video and you can take a look. Sell stop, take a look. Price, activate them, give them a little profit, then start to reverse. Sell stop, activate them, give them a little profit, reverse. Sell stop, give them a little bit profit, start to reverse. Again, profit, start to reverse. Give them a little bit profit, start to reverse. Now for the buy stop, see, a little bit profit, start to reverse. A little bit profit, start to reverse. A little bit move to upside, then reverse. A little bit move to upside, then reverse. Here, reverse, here, again, reverse. Again, reverse. So this is the liquidity swap, or we call this a stop hunt 2. Now, for sure, after I teach you the different type of liquidity, I'm going to open my chart. I'm going to show you an example. Now, the next form of the liquidity, it's equal highs and equal lows. The next form of the liquidity we're going is going to be equal high and equal low, just like the swing high and swing lows. We just went through. Traders place a buy stop above equal highs and sell stop below the equal lows. The reason why so much liquidity builds up in these areas of price action is because traders see those equal high and equal low as form of support and resistance. So if price break through these areas, they once again expect the market to keep going. In the case of price breaking above equal high, or keep going down in the case of breaking price breaking below equal lows. Once again, it's often the country that's happened, right? And the other reason of this area have a lot of liquidity, it's the price action. The traders pretty much will also try to sell from the equal lows and buy from the sell from the equal highs and buy from the equal lows, thinking they are a strong area of support and resistance. So when price breaks through, they are hitting all the stop losses as well. Before we show some example, let me just show you what is the valid equal high and valid equal low. So before we go to chart example, take a look. This is the most important thing, right? So the equal high, that means the both high, the swing points, should be equal, or the first one should be higher than the second one. So if the first one is not higher than the second one, this is going to be a liquidity sweep, right? This is not going to be equal high. This is stop hunt price where we take out the liquidity. So it should be equal, or the first high should be higher than the second one. Also, same thing here. Take a look. In the equal low should be equal, or the first low should be lower than the second one. So that's going to form the equal low. Again, this is not the equal low. Okay, maybe you're gonna in the practice, once you're gonna practice, you're gonna face to this, but this is not the equal low. Okay, this is a stop hunt price, or you take out the sell side liquidity here. That's it. Now let me show you one example of the equal high. Take a look. The equal high here. You see? So the first one and the second one. So pretty much it's a respected. If I draw a line here, you're gonna take a look. Yeah, this is pretty much a line. So it's respected. So traders think this area is going to be beautiful, resistant to sell, and some they're looking for buy stop here. But again, what's going to be happen? Price going to take the both side. That's it. Price is going to take the both side. That's it. You know. Now, let's go to one more. The equal high. Take a look. These are respected. This is the equal, right? Price going to take them, take the buy stops order, and also take those people that they are looking for sell here too. And also the equal lows for sure. See the both lows are equal. I mean, for the first one is the lower than the second one. Price going to take them and reverse, right? Again, these are pretty much equal. Price take them and reverse, right? This is the equal high and equal low. Now, let's talk about the grandfather of the equal high and equal low, which is going to be trend line liquidity. The next form of the liquidity we go through is a trend line liquidity. This is very obvious form of a liquidity built up for us. It's very well known from a huge percentage of traders to try and trade the trend line bones and the trend line like break and retest, right? You will see in the next example how market manipulate those area of price action by triggering all the pending buy stop or the seller stop order, stop losses, and just genuinely casing a havoc of those catch unaware of what is actually going on. Let me show you one example here. Take a look. These are the trend line. That means once you have a multiple reaction on the pretty much the equal and the equal high, the maximum reaction is going to be 2, and then price is going to take it out. But once you get a multiple reaction in that area, that's going to be a trend line. Okay, take a look. Price tap, the chart going to sell. Price tap, the chart going to sell. So they are on the profit. They are happy. They're going to enter with the more liquidity. So the more they enter in these areas, the more liquidity going to be above this area. Okay, and what price going to do? Price going to take them all and reverse. Okay, that's reason in these, once you see the I can say the 90% of the trend lines, they have massive manipulation because of the massive orders are behind them. Take a look to the again the trend line. See, they try to sell because they see the respect, and guess what? Price going to take them out. Right? The more respect you see, that means the more manipulation, the heavy manipulation going to be happen. Again, take a look here. A beautiful respect. They try to buy here, they are in fucking profit, they are so happy. Again, they try to buy here, they are so fucking happy, right? Because they are in profit. The market give them a profit, give them a treat, so they can enter more, right? And once they enter more, price can reverse them. Take a look at this manipulation, this massive manipulation here. And one more, beautiful respect, price take them and reverse, right? As you can see for those example, from those example, there is a lot of manipulation. Anyone who tries to buy or sell both of the trend line gets their stop loss hit. Anyone who tries to trade the breakout is often only in profit for a very short period of the time before the market completely reverses in direction, right? That is the power of understanding areas of the liquidity on the chart. It allows us to participate on the correct side of the market and trade along the side, the real move the market intending to make. Now, let's go with the next form of the liquidity, which is going to be previous day, week, month, high and low. The next form of the liquidity, it's going to be previous day, week, month, high and low. It's the same simple concept, I can say. Traders play their buy stop order above their and their sell stop order below the significant price levels, like above the previous daily high, previous daily low, and below the previous daily low, above the previous week high and below the previous week low, and same for the monthly, and expecting the price to continue in their direction, right? But we can use this knowledge to our advantage once we tie everything in this course that you're gonna have together, because there has a a lot of logic behind this concept, which you are learning. Now you understand why the equal high is equal high. You didn't understand it, and we're gonna dive into a lot of, let's say, examples in this case. So now take a look. This is the previous day high. Okay, this is the yesterday, and this is the current, let's say, today price action. This is the previous day high. Price going to take them. Their buy stop order going to get activated. Then the start going to reverse. Right? Again, price going to take them. This is the previous day low. Price going to take them, and the price going to reverse. Right? Again, price. This is the week. The more time frame you go up for the liquidity, the more higher time frame, the more stronger liquidity. Right? Because the volume of the order is going to increase. Now, this is the previous week high. Price take it out and reverse. Again, previous week low, price take them out, reverse. Now, monthly, take a look to the monthly. Price take it up, small, okay, then start to reverse. Take a look at the fucking reverse, right? Take them down, right, and start to reverse. Now, let's go with one of my favorite liquidity, type of the liquidity I can say, which is going to be Asian session liquidity, right? So above the Asia high and Asia low, it's a lot of liquidity. Now, why? A lot of people say the Asia high and Asia low is liquidity. Since the Asia is generally a consolidation period, more so in the non-Asia pairs, there are a lot of traders who will attempt to buy once price breakout above the Asia high, and traders who will attempt to sell once price breakout below the Asia low. Once again, in the form of the, let's say, we can say buy stop and the sell stop. This is one of the reasons why Asia will became the guide for the intraday trader, because if we wait for the Asia to end, we know that the market likes to stop on those Asia high and lows. It's provide us with a concept of for the coming day. Let's say it's going to give us a little bit hint for the daily bias. Let me show you one example. Take a look. This is the Asia high. Price going to take them up and reverse. Okay. This is going to be Asia low. Price going to take the low. Okay. Reverse. Why? Because the sell stop trader tried to sell here. Let's make sure that they are activated here, then start to reverse. Right? I'm gonna show you more. And also this Asia high and Asia low, it's so useful in the AMD concept. We use a little bit AMD concept in our mechanical system, which if you join the VIP group, you're going to learn them more. But this is the basic of that. So we know once the Asia low get taken out, price going to reverse and go for the Asia high. Also take out the Asia high and reverse. This is a beautiful price action that you can make a lot of money from this price action in the intraday trading, which in the VIP group, you're going to learn how to enter mechanical in this trade. Now, let me show you from each liquidity we'll learn. I'm going to show you an example. For example, the beautiful today trade that I catch was a beautiful, systematic, mechanical, beautiful trade that we catch for strategy. So I'm going to show you which type of liquidity I use. But first, let's start with the swing high and the swing low liquidity. So take a look. In this case, this is the seller stop. See, price take it up and price go up. Again, I'm going to show you one more example here. Take a look. Seller stop. Price take it. Make sure to everyone is active, and then price reversed. Let's go with the buy stop order. Should be beautiful one. Yeah. Let's go with this area. Price, take the buy stop, reverse. Buy stop, reversed. Take a look. Price take out the seller stop and reverse. So pretty much this is swing high and swing low liquidity that you can understand. Combined with a little bit market structure, it's going to help you a lot. Now, let's go with the equal low and the equal high. So take a look. This is a beautiful equal low that we can see here, right? So the first one is lower than the second one, okay? And what price did? A lot of traders, they're looking for pretty much buy here. They're going to get a stop loss, and a lot of them looking for the sell stop order here, which they also get reversed here. And see how price beautiful take this area. And also it's pretty much a beautiful sell stop liquidity. See, all of them are connected to the sell stop and buy stop liquidity. I can say the buy stop and sell stop liquidity is the mother and the father of each liquidity you're going to learn. And you learned, or you will going to learn in the VIP group. So the buy stop and sell stop, it's the main one. Now, take a look. This is a beautiful trend line liquidity that we have here. Okay, just take a look to this manipulation here, right? This beautiful trend line liquidity, right? So they're going to sell here. They're going to be profit. They're going to be so fucking happy, right? Especially the swing trader. As I told you, the more time frame you go up, the more strong manipulation liquidity you're going to see. So take a look. They're going to sell. They are so happy here. Guys, they are so happy here. They are the profit. And this reaction, it's not by random. The market maker says, okay, I'm going to pay them. I'm going to pay them because I want more liquidity. They're thinking about the plan B. They're on the back stage. You should be on the back stage in the market. And take a look. They try to sell here because they are happy. For sure, if they are risking 1% here, 1%, 1% here, they're going to risk 5% here. And imagine if they hold their orders here, imagine how many active stop losses are here and the more liquidity here. And guess what? One news price is going to take them all, right? Let me show you a form of the equal high. This is a beautiful form of the equal high. See? With this beautiful break-off market structure, 100% they're going to look for sell here or here. And guess what? Price take them up, right? And if they want to look for the buy stop, they're going to be in the profit. They're going to be happy and then price reverse for sure. Now, let's look for the, again, equal high and a trend line liquidity for sure. Yeah, basically here is the awesome one. See, this is trend line, price respected. Here, then prices start to reverse and take them all. Again, we can go with the equal high. This is the equal high, and price take them up. And we can go also with the equal low. Here's the beautiful equal low that we have. Price take them, price reverse and reverse. Now let's go with the previous daily high and previous daily low, which I personally used it for today market. So if I drop down to the low time frame. So take a look. This is the yesterday candle. Yesterday price action, and this was the lowest area and this was the highest area, which price took the daily previous low and tapped to my key level, which you're going to learn. The key level is one of the important things to understand the daily buys. And price tapped to this area and reversed. Take out the daily previous high. Okay. Also, you can see here pretty much. I can go to the daily time frame and I can show you some examples here for sure. Take a look. Let's say this is the yesterday candle, daily previous high, daily previous low. Price didn't able to take out the daily previous low, but at least take out the previous high and reversed completely in the bearish, right? Again, take out the previous low. And what we have here again, see, take out the previous daily low, which was the equal low with this one for sure in the low time frame, and price completely reversed. And you can go and try this in the monthly or the weekly time frame, which if you can take a look, price take out the previous daily high, we can expect a reverse here. Take a look here, price take out the daily previous weekly low and completely reversed. Okay. We can go more here, take out the previous daily low, reversed. Here again, take out the high, daily previous high, and reversed. And also we can do some monthly here. And then we can go to the Asia session also, one of my favorite one. Take a look. Price take out the monthly previous high and start to reverse. You're going to see the monthly high and monthly low is one of the important one, I can say. It's one of the important one. And yeah, this one. Take a look. Take out the monthly high and reversed. Take out the monthly low, reversed, and close here. Now let's go with the Asia session. Now take a look. Price going to take out the Asia low, go Asia high. Asia low and reverse. Go for the Asia high. Again, one more here. Asia low get taken out. Then price going to go for the Asia high. And as we can see here, reversed. Okay. And take a look. Asia low get taken out. Price reversed. Take a look. Asia low, the sell stop orders get taken out. Price reversed. Just a little bit profit to make sure all of them they're in. They're happy. Take out them and start to reverse to just hit their break even maybe. But here maybe you ask Evo, but what about this one? Yeah, price didn't just take the Asia low and come down, right? Maybe they're happy, they're in the profit. But usually in these days, we're not gonna see any good opportunity because we follow based on the liquidity. So in these days maybe, and also Asia session moved a lot here, so nothing in this day I can say. But mostly, if you take a look, the most beautiful price action for those people that they're gonna trade on liquidity, it's these type of the price action. Price take out the Asia high, reverse, take out the Asia low, reverse. So if you join a VIP group, what are you going to learn? You're going to learn to enter here, to enter right here, which the exact mechanical system by using these concepts I'm teaching you. So yeah, this is basically the liquidity, the whole thing that you need for the liquidity. You can take this and create your own strategy, okay? Because the liquidity is so fucking powerful. But you should understand, if you want a strong liquidity, you should, the more time, a high time frame liquidity you have, okay, the more strong liquidity became. And this is also act opposite, okay? So I hope you enjoy it. Now, in the next lesson, I think I'm going to talk about the POI. And don't forget to do some practices and for sure train your eye to spot them fast as possible. Cheers, your favorite mentor, Ebal. Welcome to lesson number 4, which we're going to talk about the point of interest. I'm going to open your eye today so you can understand where is the specific reaction, any reaction came from in the market. So first, let's start what is the point of interest. In this lesson, we are going to cover the point of interest for short. A POI is a price level where we can expect the market to give a reaction from, and an area where we can expect a setup to form, and can also be where we can potentially execute a trade. Okay, so the main issue people have with the POI is that there can be so many of them visible in the chart, and the majority of the people don't know which POI to choose. And I'm sure that maybe if you're an advanced trader, you have this problem too, that you're gonna have a lot of POI and you don't know which one is the high probability. So which one is gonna be playing? We can execute trade and it's gonna be high probability POI. That's why we most have some rules behind the way we select them to ensure we give ourselves the highest odds possible. So let's start with this rule. I'm going to teach you the rule that I'm using to take my POI. So it's a 4 different rule. A high probability POI must be selected from higher time frame. The high time frame is king and always be king, right? This is the main reason why people can choose a POI, because they spend their time looking for it on the lower time frame and end up having too many options, which is not an ideal method for long-term profitability, right? So you should take the POI in a high time frame. Again, as I told you in the last session, the more you go to the high time frame, the more potential manipulation or strong liquidity you're gonna have. Again, same for the POI. The more you take it from the high time frame, that's a high potential area. So let's go with the rule number 2, which is going to be a high probability POI must have a liquidity resting above it. If you're looking for to buy, and below if you're looking to sell, right? This gives the market a reason to tap into your POI, and it's also give the market a reason to reverse from your POI. So each POI you're going to choose, below and above it, if you're looking for buy, for sure above, and if you're looking for sell, below it should be a liquidity. So that's a reason of the manipulation. So why are you expecting the price tap to the POI and just come down for no reason? No, that's not going to be accepted. The manipulation should be behind that logic. So, and the rule number 3 is going to be high probability POI must be unmitigated. It should be fresh. Okay, and the last rule, a high probability POI should be the closest to the liquidity. Okay, in the topic of the liquidity, we saw that how quick they can cause the manipulation. So it's most likely you will be very quick to reverse. They will be very quick to reverse. So if your POI is not closest one, it's likely you will miss the move. So let's start with the first type of the POI, which is an order block. Maybe you guys will know what's the order block, but the way that I take the order block is going to be a little bit different from you. The first type of the order POI, it's an order block. We have the bullish order block and the bearish order block. A bullish order block is the last down candle or the candles before up move. I'm going to show you an example. The reason I say candle, it's a plural. That's because of the same consecutive. The color candles are just one solid candle on the high time frame. So when I say the candles, I mean the candles. If you go to the high time frame, that one bullish candle you're going to see, it's that 5 bullish candle going to be one. I'm going to show you one example, right? And I say, and also for the bearish order block is the last up candle or candles before the downside. For an order block to be valid, it must take out the liquidity. That's give a purpose. You can mark out the entire candle if you like. However, the majority of the value is in the body. So far, I mark it starting from the body because there's a lot of volume there. So it's going to give me a snipe entry. Just to be aware that there will be times where it doesn't tap to the body also. So that means you should just, if you just want to look for confirmation in those areas, which I'm going to teach you how to look for confirmation in the last lesson, I guess. And just to take the whole area. Now let me show you some examples here. Now take a look to this bullish order block, right? So the last bearish candle or the downside candle before the bullish move. So, and the order block should take out the liquidity. So you can take the whole area or you can take the body. So, but take a look, there is a liquidity above it. It's the nearest liquidity and price tapped in and got a reverse, right? So let's go with the bearish one. Take a look. The last bullish candles before the bearish move, which in this case we can take the whole area as a body area, and this area get taken out by liquidity. We have the liquidity risk below it, and price going to take out the liquidity and going to reverse. So this is the order block, bearish and bullish order block, which we're going to dive into some examples in a live chart. So now let's dive into the breaker block. The second type of the POI, it's bearish and bullish breaker block. The breaker block is simply an order block that was not respected. So when price breaks through the order block, the market can return to it on their side and use it to make its move. The breaker will typically be found in a specific area of the structure. I will add a diagram here, so let's take a look. So as you can see here, the breaker block, it's usually that order block didn't get respected. So this was a bearish order block here, and price didn't respect it and create a break of market structure to upside. And what we can expect in the breaker block, that price pull back and tap to that order block and cause the bearful reaction for us. So pretty much a bearish failed order block going to be a bullish breaker block for us, and failed bullish order block is going to be let's say bearish breaker block for us. Take a look. This is a bullish area here, okay, that get failed. The bullish order block get failed by break of market structure here, then the reverse price and the retracement price tap this area and pretty much come down. Now take a look to this example. Take a look, just follow my mouse, okay? So this is a bearish order block, right? The last bullish candle before the bearish move, and also to take on the liquidity. Now price break this area with the break of market structure. So in this case, what price gonna do? Price gonna, in the pullback, we can expect this area can act as a POI, and price gonna go up for sure. If you have a liquidity here, that's gonna make it more high probability area, right? Now take a look to this one. Just follow my mouse. This is a bullish order block, right? The last bearish candle or candles before the bullish move, right? So price didn't respect it. Price just break this area with the break of market structure. Now this area changed from a failed bullish order block to the bearish breaker block, and we can see beautiful liquidity here. Price tapped in and it starts to reverse. So now let's go with the imbalanced fill. The third type of the POI is imbalanced fill. Maybe a lot of you guys just tried ICT concept, which is the fair value gap. It's the same name. Or I think API. A lot of people call it differently, but the way I look to the fair value gap is completely different. I look at it as a fill area, which I'm going to talk about. So, but first, let me just talk about, for those who don't know, what is the imbalance. When price has not been delivered fairly between the buyers and sellers, the market will become one-sided, which end up leaving an imbalance or the gap in price. The way we can identify an imbalance is the gap in the middle of the three candles. So between candle 1 and candle number 3, there will be a gap where the candle 1 and candle 3 do not touch. If they touch, then there is no imbalance. Let me just take a look, right? So let's take a look here. So 1, 2, 3. The first and the third candle leave a gap. So this area is going to be imbalanced, right? Now, take a look. The first and third, they are touched. This is not imbalance. This is the bullish one. The first and the third one leave a gap. This is imbalance, but if they touch, there is no imbalance going to be here. Now, what is imbalance fill? Now that you understand imbalance, you can now understand what I mean an imbalance fill. To put it simply, an imbalance fill is when the market returns an imbalance and completely fill the gap. So in a bearish example, the imbalance would be considered filled once price tapped to the low of the first candle. Take a look. This one, we're talking about this one. And pretty much in the bullish one, price tapped to, again, fill this area. So let me show you one example here. Take a look. This is the bullish imbalance. 1, 2, 3, right? Between this here and the third candle, there was a gap. Now, price filled the 50%. Maybe the ICT trader is going to enter. We don't care. We're looking for an imbalance fill, right? So in this area for me is still didn't get filled, the whole 100%. So I'm looking for this area as my imbalance fill. Now, maybe you ask, Evil, but isn't this area, it's a bullish order block to take out the liquidity? Yes. So sometimes you're going to have a multiple POI in one line. And if you have those multiple POI in one line, guess what? You have a fucking magic POI. Okay? Because you have a liquidity, above or below it. It's unmitigated. It's 2-3 top of the POI in one line. And guess what? The market gonna actually, I mean, the price gonna respect that shit, right? So that's one of the important things. Take a look. Price filled it and go up. And for sure, we had a liquidity below it. Sorry, above it. Let me show you one more example. See, 1, 2, 3. Here is the gap and what we are looking for here, not the 50%. Maybe price tapped the 50% and reverse. We don't care. But we're talking about the imbalance fill. Price fill this area and reverse. I'm going to show you an example. Now, there are 3 more POI left, which those are also a strong and great POI. Maybe you never heard about them. And there are, I explained them full detail on a VIP group, which if you're interested, for sure there is a link below, which you can join. But right now, let's dive into those POI. So I'm going to go to the high time frame. I'm going to start from the high time frame to show you those type of the POI. Let me just hide this so we can have a full focus on this area. So let's just start with the order block, right? Let me just go to the 1 hour time frame. Okay, take a look. This is an order block, right? The last bullish candle before the bearish move. You can take the whole area or you can take the body here, right? Now, take a look. This is a bullish order block. The last bearish candle before the bullish move. Maybe you see a different type of the POI. Congrats. You have a pile of eyes, right? But I'm going to explain all of them step by step. Okay, this is the bullish and bearish order block. Now, let's dive into the bullish and bearish breaker blocks, right? So, take a look. This was a bullish order block. The last bearish candle before the bullish move. But what the price did, price just break this area with the break of market structure. And price retrace, tap to this area, and respect it. So this is a bearish order block. Now let me show you one more. Take a look. This was a bullish order block, right? The last bearish candle before the bullish move. Now price break this area with the break of market structure. See, price break this area with the break of market structure, then price reversed. Okay, now let's go to one more. Let's stay in the 4 hour time frame. So take a look. The last bearish candle before the bullish move. This is a bullish breaker block. Price break this area, the break of market structure. So now this area became, let's say, a breaker block. See, price tap in and give us the reaction here. Now let's look for one more. Which I think we can go to the lower time frame and look more there. So I can go to the 15-minute time frame. Okay. And take a look. This is a live example. This is a bearish order block, the last bullish candle before the bearish move. Price break this area as a break of market structure. This area in the future can become a beautiful breaker block area. And also we have a liquidity below it. Take a look. Sell side liquidity below it, so this is going to make it stronger. Let's dive into one more example. Yeah. This is an awesome one here. This is the bearish order block, the last bullish candle before the bearish move, right? Now take a look. Price break this area. So now this area became a bullish breaker block. And see, price react to it. Now let's dive into the imbalance fill. Take a look. 1, 2, 3. We have a gap here, right? There is a gap here. But what are we talking about is the imbalance fill is going to be this area, we're talking about the fill. So price should fill this area, and see, price gonna fill this area and come down, and I'm gonna react. I'm gonna show you one more example here. Again, there is a gap here. This is an imbalanced fill. We don't care if price filled to 50%. We are talking about the fill, imbalanced fill, right? I can show you one more also. See, one example here. This is a imbalanced fill, price 50%. We don't care about the 50%. The only thing that we care is the fill area. So in the future, we can take this and also see this the order block here that take out the liquidity, which is insane. And also this is going to be a future liquidity for us. Should be smart here. So in this area, in the next, if price come down, yes, we can take this area as a beautiful imbalanced fill. Now, one more example of the imbalanced fill, and we can go to practice phase. So take a look again. We have an imbalanced fill. What we're going to talk about, we're looking for this area as an imbalanced fill, and also we have a beautiful order block. Price filled this area and gave us a beautiful reaction. So that's it. Just don't forget to practice. Train your eye to identify these areas as fast as possible. The more you fast become in technical analysis, the more you are going to be stay away from the psychology and the psychology decision. So I'm going to tell you why in the last session that psychology also is why it was so important. So, yep, that's it. Now, see you in the next lesson.
Well, everyone, welcome to the next session. Well, as you can see, I get sick in these time, but nothing gonna stop me to provide information and provide the best thing that's gonna help you in the market. So I'm not the man of the excuse. So let's start with today lesson, which we're gonna talk about the ranges. Now, the first thing we should understand is what is the ranges, which we're gonna talk about the core elements of the trading range. Pretty much, the trading range is a concept we use to understand where is the liquidity and our playground. The range is going to open your eye to uh, have an area like a chessboard to look for entry and the liquidity. Going to make everything so clear for you. And instead of you looking for the liquidity everywhere in the market, you have some area to look for as your trading range on the liquidity, and you can easily enter. It's going to make this lesson going to make everything simple for you. So there is a phenomenon that consistently repeat, which we call this the trading range cycle, right? This gives us an edge. If we understand where we are in this cycle, we can approach the market with a high level of accuracy and the understanding of our directional bias. Understanding the trading range is key. Now, the trading range consists of the multiple different pieces that we will eventually be blended all together. So we are going to break it down on what I call the core elements of trading range. So let's get started. The first one you should understand, the first core element is the bullish and bearish QM. The first core elements of the trading range are the bullish and bearish QM. The QM are what frame the trading range and is how we confirm when a range is formed. They are very easy to understand since there are only two things that need to happen to identify them. The first one is to identify a bullish QM, you need to see a stop hunt to the downside and a break of market structure to the upside. And for identifying the bearish QM, you need to see a stop hunt to the upside and a break of market structure to the downside. Let me show you what I mean. So take a look. This is a bullish QM, a stop hunt to the downside and a break of market structure to the upside. Take a look. This is a chart example. This is a bullish QM here. Stop hunt to the downside and the break of market structure to the upside. And this is the bearish QM that we have. Stop hunt to the upside and a break of market structure to the downside. Right? Take a look. Price take out the stop hunt, sweep the liquidity, and break of market structure to the downside. So now that you understand how to identify the bullish and bearish QM, you will be able to identify the beginning and end of the trading range. In the next section, we are going to go through what those bullish and bearish QM represent in the trading range. So the first one is the strong high and the weak low. At the beginning of the bearish trading range, we are going to see a strong high, otherwise known as a bearish QM. At the end of the bearish trading range, we are going to see a weak low, otherwise known as, let's say, a bullish QM. That weak low formation or opposite QM is going to let us know that our bearish trading range has been confirmed. Let's see an example and I'm going to tell you what I mean. But before that, sometimes you will see in a range with a strong high as a QM, but no QM confirmation at the weak low, right? In these cases, you can take the weak low as a tree candle confirmation in the obstacles. So what is the obstacles? Pretty much is a counter trend intraday POI acting as an obstacle, right? So the strong high, but the strong high should be the QM, but the weak low can be a tree candle confirmation and obstacle, but the strong high should be QM formation. So this is the example. Take a look. This is a bearish QM. That's the bullish QM. Stop hunt to the upside. Break of market structure to the downside. Stop hunt to the downside and break of market structure to the upside. These two gonna form our bearish trading range that we call this strong high and a weak low. And here's going to be a weak low. Now, the strong low and a weak low is going to be at the beginning of the bullish trading range. We are going to see a strong low, otherwise as a bullish QM. At the end of the bearish trading range, we're going to see, let's say, weak high, otherwise known as a bearish QM. That weak high formation or opposite QM is going to let us know our bullish trading range has been confirmed. But again, the strong low should be QM, but the weak high can be treated in the confirmation in obstacles. So take a look. This is an example of the bullish trading range that you get this strong low, stop hunted to the downside, and a break of market structure to upside, which that mean is this is a bullish QM and this is the bearish QM that we have a weak high to the stop hunted to the upside and bearish trading range. And the break of market structure to the downside. And this is a chart example. Take a look. Once you get the weak high, that's mean your bullish trading range confirmed. This is example of the bullish trading range. Now, what is the external range liquidity in the bullish trading range, let's say? Now that you understand a strong low and a weak high that's going to form the bullish trading range, you will now able to understand what we call external range liquidity, or ERL, for a bullish trading range. The QM that's formed the range are the external points of our trading range. So those became the external range liquidity. In a bullish trading range, we are expecting a new high to be created. So our target is going to be the weak high or external range liquidity. Let me show you an example. Take a look. This is a bullish trading range. In a bullish trading range, we have a strong low and a weak high. So we are expecting to price break the external range liquidity, that is going to be the weak high in the bullish trading range, and create a new high, which I'm gonna tell you, I'm gonna talk about this more and more. But remember, in the bullish trading range, the weak high for us is going to be the external range liquidity, right? Now in the bearish trading range, again, which known as a strong high and a weak low, okay, the weak low area is going to be our external range liquidity of the bearish trading range, right? So this is an example. You have the bearish trading range, strong high, and the weak low, right? So this weak low area, it's going to be our external range liquidity in the bearish trading range, okay? So in the bullish trading, the weak high, and the bearish trading range, the weak low, going to be our external range liquidity point, right? Now let's talk about the internal range liquidity. If we have an external range liquidity, for sure we have something that's called internal range liquidity. The internal range liquidity are the swing highs and the swing lows, the swing points that you learned in the first lesson inside of our trading range. Above the swing high and below the swing lows, as we learned, there are the buy stop and the sell stop liquidity, right? So the low or high that's going to get broken to confirm the trading range will also be seen as internal range liquidity. Let me show you some examples here. So this is a bullish trading range. So we had the strong low, we had the weak high. We know this weak high going to be our external point. But before this weak high going to get taken out, we have something called internal range liquidity. That means the liquidity is inside the range. And if you take a look in the bullish trading range, every swing lows here that didn't get broken yet, it's going to be our internal range liquidity, and we are expecting to price take this liquidity, sweep this liquidity first, sweep the internal range liquidity first, then go to the external, which I'm going to talk about that. Now this is the bearish trading example. See, we have a strong high and a weak low that confirm our bearish trading range. Now this weak low area going to be the external point for us, okay? And all these swing highs, swing highs here for us is going to be the internal range liquidity that we are expecting to price first sweep the liquidities inside the range, okay? Because at the end, if you take a look, there is a buy stop orders above this, and then go to the external. Now, we have a premium and discount area. Once we have our trading range identified, we can now implement what we call premium and discount. In simple term, discount equal cheap and the premium equal expensive. If you are thinking logically, it's more reasonable for you to want to buy something at the cheap price and sell something at an expensive price. The market works in the same way, right? Let's say I want to sell this phone, right? I don't know, so let's say iPhone 15 Pro Max or 16 Pro Max, I don't know. I think it's a 15 Pro Max, right? I want to sell this phone, right? So if I want to sell this phone, I want to sell it as expensive expensive price level in the market of this phone, right? I don't want to sell it cheap, right? If I have a car, if I want to buy a car, let's say a used car, I want to buy the used car with the good condition at the cheapest level I can. Okay, there are three car, the condition are awesome, the mileage is same, the model is same, the color is same, but each one have a different price. So which one you need to choose? The cheapest one. So the ranges is going to be the same. So the way we apply, okay, and also you can use the Fibonacci. There is a setting that you should use 0, 0.5, and 1 to identify it. So there is a setting that I can zoom in and you can take a look. Zoom in. Let's zoom to the, yeah. So in the Fibonacci, you can go with the 0, 1, and 0.5. So now let's talk about applying the premium and the discount, right? The way we apply the Fibonacci to our trading range is by measuring it from the high and low of the trading range. The 50% is known as equilibrium. It's above the 50% on the premium price, which is we call this expensive area, and below the 50% is known as a discount price, as a cheap area. So in a bearish trading range, we only want to sell in the premium area. We want to sell, right? We want to sell in the expensive. We want to sell this one in expensive. So this is going to go at above the 50% as in the premium area. And in the bullish trading, if we want to buy in the bullish trading range, we want to buy it below the 50%, which is going to be our discount area because we want to buy it cheap, right? Let me show you some example here. Take a look. This is a bullish and bearish premium and discount application. This is the strong low and a weak high that you have, yeah, for the internal and external that you learn. But we want to buy at the discount area. You're going to draw Fibonacci from strong low to the weak high, and the 50% below going to be the discount area. So we want to buy in the discount area at the cheapest level as possible. And this is the bearish trading range. This is the strong high and weak low. And internal liquidity is for sure the weak low going to be external liquidity. And we want to sell at the premium area. You're going to draw the Fibonacci from the strong high to the weak low, and this is going to be the premium area. So the trading range cycle. Now we have covered the basic core elements of the trading range. The QM, which represent either strong high, weak low, or the strong low, weak high. The external range liquidity, which are the external points of the trading range, especially the weak high and the weak low, since those are the targets to create a new high or a new low. Internal range liquidity, which is going to be the high and low inside of the trading range. And lastly, in the premium and discount to know which area of the trading range we are looking for buy or sell from. Now I teach you everything piece by piece and step by step, and we blend it all together. If we blend all these together, we're gonna have something that's called the trading range cycle, right? The trading range cycle is simply the process of price seeking internal liquidity to then to target the external liquidity, and then form the external liquidity back to seeking to the internal liquidity, and so on. So this is the cycle. Now, let me show you how this cycle works. Let's say once you have a bullish trading range, strong low and a weak high, you have the internal points, you have the external points. The first thing you're going to expect is price, take out the internal point, come to the discount area, tap to the high time frame POI, then from the high time frame POI, reverse and go and take out the external liquidity. Same thing in a bearish trading range. Once we have the strong high and the weak low get confirmed, we have our internal points first, which we are expecting to price take out the internal, go to the premium area, tap to the high time frame POI, and from the high time frame POI, price reversed and go for the external liquidity point. This is range trading cycle that happens every day, which I'm going to show you in the chart, right? As you can see, this is the final product after putting all pieces together. We saw for a bullish trading range, the market pushed down in the discount area and took the internal liquidity and tapped to the high time frame PO and reversed to the external point. And same for a bearish trading range, price gonna push to the premium area, took the internal point, tapped to the high time frame POI and reversed to the external liquidity. Now let me show you some example of the trading range, right? Take a look. This is a strong high and this is the weak low, right? So the weak low get confirmed, the both high get confirmed with the QM. So we have these swing highs. It's what we call the internal liquidity. Price gonna go to the premium area in this case, above the 50%. Take out the internal, tap to the high time frame POI. Then price gonna come down and reverse and take out the external liquidity or the weak low in this situation. Take a look, strong high and the weak low get confirmed by the QM formation here. We have unswept a swing high in this case, which is going to be our internal liquidity. Price going to push, go up to the 50%, okay, which is going to be premium area. Take out the internal, tap to the high time frame POI, reverse to the external liquidity, okay? So there are some more example, which I will going to show you in the chart. And we have a different trading range trap, which In the VIP, once you join, you're going to learn the different range trading traps, so you can understand why sometimes market you don't have any internal, so price going to engineer the liquidity. So by joining the VIP, you're going to learn all of the mechanical system that you can easily identify as advanced. Now let's go through to the chart, and I'm going to show you some example of trading range. Well, I want you to take a look at this example here. What we have a bullish QM, stop hunt to the downside, break of market structure to the upside, which this is going to form our bullish QM. Okay, and here what we have, it's stop hunt to the upside and break of market structure to downside, which what this is going to get formed, this is going to be our bearish QM, which if we have a bullish QM and a bearish QM, this is going to be a strong low, and this is going to be our weak high. So I have the bullish trading range right now. So once I have a bullish trading range, so here's the trading range cycle comes to play. What we are expecting to first price take out the internal, come to the premium area, tap to the high time frame POI, then go with the external. So right now I'm not going to look for buy for this external point, right? The fifth thing I'm expecting is price take out the internal. So I can see I have a swing low here, which is going to be my sell side liquidity or internal liquidity as my internal liquidity to get taken out, but get swept first as a trading range cycle. Again, I'm going to write the trading range cycle for you here. So what we are expecting, range form, then what we are expecting, internal liquidity gets swept, internal liquidity is swept, then what we are expecting, premium or discount area, then high time frame POI, then what we're expecting, price come and take out the external liquidity. This is our trading range cycle. So my range form, I have the internal liquidity, which I'm expecting to price sweep this. Now, this I'm expecting to price, come to my discount area in this case, which is going to be below the 50%. So that's mean I can look for buy at the discount area. Now I'm going to choose my high time frame POI. In this case, let's say my high time frame POI. Let's go to the 4 hour time frame. So what we have an imbalanced fill and a beautiful order block here as my high time frame POI. Now let's get back to the 15-minute time frame. So, and I have my discount area. So everything makes sense. So the third thing I'm going to wait for to price, take out the internal liquidity, which what we can see here, you're expecting to price in the basically in the VIP Discord, you're gonna learn how to look for sell here and start to stack onto this area. These are the another type of the liquidity that price injuring in the life of the market, which you're gonna learn how to identify this and easily look for sell here, look for sell here, look for sell here until this is a scalp opportunity. So now take a look. Basically, price take out the internal liquidity. Now price range for internal gets swept. The premium, the discount area tap. We are looking for the discount area to look for the buy here. High time frame for get tagged. Now after that, we are expecting to price take out the external liquidity, right? So basically, we can look for a beautiful buy here. You can put the stop loss here, or you can put the stop loss anywhere. Here for more risk to reward, but the high risky one, or we can go with this one, which again in the VIP Discord, I'm going to talk about the entry, how you can enter in the next lesson. But in the VIP Discord, you're going to learn our trading style, the day trading, intraday trading. The intraday trading, scalping, swing trading, in using this concept in all time frames. So price tap to the high time frame POI. In this case, we are expecting to this strong low get form and the weak high get pretty much swept out, right? So what we can see, prices start to move up and take out the, let's say, external liquidity. So if you want to do the high risk to reward, you can easily catch a 1 to 3 here. But again, in the VIP Discord, I'm going to teach you that how you can enter as a confirmation here. So basically, you can enter with the higher risk to reward, or how you can make it swing trading, and a lot of more things that's going to give you ability, flexibility to use your own trading personality for the entries. But the concept is going to be same, but more advanced. And C, price takeout the external liquidity. So this was, let's say, example of the trading range. Now in this next lesson, what I'm going to talk about the entry. I'm going to teach you how you can enter, and basically I'm going to show you more example of how the ranges and the entry of the ranges, so you can understand how to find a high time frame POI and enter, pretty much the last steps of these. And then guess what, your eye is going to completely change. So yep, don't forget to practice and take a note. See you in the next lesson. Well, everyone, welcome back to the new lesson. In this lesson, I'm going to teach you how to enter. Now, you learn all the basic concepts here. Now, we're going to put them all together, and I'm going to teach you how you can pretty much enter, and pretty much I'm going to do some trade breakdown on how you can approach the market, right? So let's get it started. I'm going to put myself here, right here. Okay. So the first important thing is it's better to wait, pay attention about the time to Asia session get finished. Now, basically, also I'm going to show you how the market structure is affected. The ranges affected the market structure, right? So what we can see, we are in the bearish market structure, and the thing is happen is even in the high time frame. If you go to the high time frame, you're going to see we on the bearish market structure. Now, Asia session finished for me. I can confirm my range, so I have a stop hunt here. I have a stop hunt, and I have a break of market structure. Stop hunt to the upside and break of market structure to downside. So I have my bearish QM form. Now, do I have a bearish QM form? Do I have a bullish QM to get form? Not yet. So I'm going to wait. And as I can see, I have a stop hunt and a break of market structure right here to form my bullish QM to confirm my range. So this is going to be my bearish trading range, right? This is going to be my bearish trading range that gets formed. Now, just remember the cycle, okay? The cycle is one of the important things. First, we are expecting to internal liquidity get taken out. So what I can see, I can see a lot of swing highs here, but these swing highs are high probable to get taken out because these are making a trend line liquidity, and also we have one swing high here, which is Asia high liquidity is one of the important. So I'm going to stick to this high probable swing high to get swept, right? Yes, I have a swing highs here, but these are make more sense. These are have high possibility to get taken out, right? Now, once I choose my internal liquidity, just follow the range cycle. Okay, we are looking to buy at the premium area, right? So are we going to go and look for the high time frame POI above my internal liquidity because I'm expecting that this area get taken out, right? So the nearest POI I can see is this beautiful order block here. Okay, now if I come back to the low time frame, pretty much, yeah, sure, you can refine this area. Now I'm going to talk about the entry. You can refine the low time frame by dropping down to the step to low time frame. You're going to see you have an imbalance field here. You're going to come down to also you can see you have an open area order block. But the more you refine, the more chance you have to lose the trade. So I'm going to stick to this imbalance fill that I have. As you can see, the 100% didn't get full, didn't get pretty much fill. So now I'm going to wait to price take out my internal liquidity to follow the range cycle, right? So price, as you can see, take out my internal liquidity, tapped to my refined area. So in this case, you can enter direct entry on these areas, or you can wait for confirmation entry, right? So it's completely dependent on trading style. In the VIP Discord, our approach is different based on the trading style that you have. We have some quiz that we're going to identify your trading style. Are you a scalper? Are you a swing trader? Are you intraday trader? And for each, you have a different approach. Not the approach, the whole, talking about just entry approach. But in this case, let's say if you want to have intraday trading. So if you want to go scalping for sure with the elements that you're going to learn in the VIP trading, you can go scalp here onto this area. But there's nothing else here. So yes, now for the stop loss, the best you can do is put the stop loss above the strong high. Okay, you can put this stop loss if you want to save a stop loss, or if you want to risky, if you want a high risk to reward, you can put it above the high time frame POI or above the refined area. It's completely dependent on you. But the more you're gonna just cut out the stop loss, the more chance you have to get taken out. So it's better to just identify the liquidity point if the liquidity point is strong. So in this situation, because this liquidity point is strong, I know the chance that price can go up and take this liquidity is gonna be lower. So what I can do, I can just stick to this one. So these are the things that you should practice and you can understand. But again, in the VIP Discord, we have a mechanical rule for this. Now we can enter here. We can because the price taken out the, let's say, internal liquidity. Now what we can see here, price tap to the high time frame POI, and we can expect to price reverse to the external liquidity. So now we can expect the internal liquidity get taken out. We are in the premium area, price tap to the high time frame POI. Now we can expect go for the external range liquidity. So now I'm going to play the market. As you can see, price strictly go to the external range liquidity and pretty much a new day start. This is the Asia session, right? So why price didn't go up and injure a lot more liquidity? Because the strong point of the liquidity here that get taken out. So that reason I took this entry. But if I saw yes, the liquidity wasn't so strong enough, I could go with the safe entry here. So now let's keep continue again. What I can see, I'm still in a bearish market structure. I'm going to wait for the Asia session to finish. Now, what I can see, again, I have stop hunt here, right? And a break of market structure right here, which is this kind of for my strong, I mean, the bearish QM, strong high. But do I have any bearish QM to confirm it? Not yet. So I'm just going to wait more. As I can see, I have a stop hunt and a bullish QM form right here. So now my bearish trading range confirmed. So now, again, we get back to the most important thing to identify the trading range cycle. We have the range, what we are expecting to price first sweep up the internal liquidity. Again, as you can see, there's a lot of internal liquidity here, but we're just going to talk about the high probability one. So the high probability one here is the swing high, the buy side liquidity, which is matched with the Asia high. So this is the high probability one, can get taken out, but it's not much strong enough as this one. Maybe price can push it above more, come down before tap to the high time frame POI, and engineer more liquidity, which is this is one of the range trap that you're going to learn in the VIP. So, but yeah, but this is the thing I'm going to go with. Now, what are we going to go do? We're going to stick to the premium area, right? So we're going to look for sell at the premium area. So what I do, if I go to the high time frame, I can see what I have here. It's basically I have this let's say, we can say the imbalance fill, but also I have, let me check, I have some support break resistant area here. Also, I have some unmitigated wick here, which you can choose the full area. Now, if I drop down, if I want to refine this, easily I have this imbalance fill, so I can go with it as my refinement. So again, what are we going to do to range cycle to get complete, right? Okay, so we're going to wait. In general, you could get taken out. See, price tap to the refine area. Basically, we can enter here. Now, as I told you, because the liquidity wasn't strong enough, maybe price can engineer more liquidity like this, as you can see, and take those area up. So the best option and choice for me here to just put the stop loss above this or give it a little bit of space, or we can go with this strong high if you want to have more win rate and more safe one. So which in this case, my goal is to show you a different possible scenarios here. So as you can see, prices start to drop, okay? And maybe price engineering more liquidity. So that reason, because the liquidity isn't strong enough, it's better to us to go with this one. But again, if you want to take a risk, you can go with this one. It's completely dependent on you. My goal is here to show you guys which one is make more sense. So I'm going to play the market here. See, again, price, because this liquidity wasn't strong enough and a new day start, so price just basically is playing on these areas. So now, internal liquidity get taken out, price tap to the premium area, tap to the high time frame POI, we are expecting the external liquidity get taken out, right? And as you can see, price take out the external liquidity in the next day, right? So now let's get back to a new day. Again, I'm going to wait for the Asia session finished. Okay, so I'm at a bearish market structure, strong stop hunt break of market structure. I have my basically the bearish QM, which is going to form the strong high. And do I have any bearish QM? No, I don't. So I'm just going to wait. Oh, that was fast. Okay. So, so once the bullish QM formed, as I can see, price just go up and strictly take out the, let's say, a strong high. So pretty much in this case, we don't have any entry because we was waiting for our bullish QM to get formed and price take it out. So, and as we can see here, take a look, the ranges are connected to the market structure, right? We was on the bearish market structure, price shift and trend from here. Okay, take out the strong high. Now we are in the bullish market structure. Now, I'm just going to play the market right now to take a look again because we are now in the bullish market structure. Take a look how price going to react, right? Take a look here. Price again. We have a stop on break of market structure. The weak high wasn't so good enough. You don't have any internal liquidity here. Price again swept this area. So it's dependent on the high time frame break of market structure you're going to get here. If the break of market structure, as I told you, is with the body close, it's a good one. It's with the weak close, which in this case it's with the weak close in the high time frame. If I go to the 4 hour time frame, you're going to see it's with the weak close. So that's mean that the reversal can be happen here. So you can stick to the bullish market structure in this case. And let me just drop down to the 1 hour time frame. So what we can see, let me just play the market. Ah, that was too fast. My bad. So yeah, a new day start. What are we going to look for? Because we are in the bullish market structure, we are looking for a bullish trading range, right? So what we can see a stop hunt formed right here. Or also we can take this as stop hunt here just to make more sense. Stop hunt to downside, break of market structure to upside. And we have a bearish QM formation here. Take a look at stop hunt, break of market structure. Everything makes sense. Our trading range formed right now, strong low and a weak high. Now we're gonna follow the range cycle, right? This is a bearish trading range. We're on the bullish market structure. We want to buy in a discount area, right? So this is gonna be our internal liquidity. Okay. Now if I went to the high time frame, the nearest POI below this area for me. So let me see what I have. I have this beautiful order block right here, which also you can refine it in the low time frame, as I told you, but the imbalance match with the imbalance here, there's nothing wrong with it. So I'm just going to take this one. And what we can see, yeah, as you can see, price engineered more liquidity here and take it out, which this is one of the range traps type you're going to learn in the VIP. So price take it out. So again, you can enter here, put the stop loss below the strong low or above below this. It's dependent completely on your trading style. But here's the range cycle is so important, right? So now internal liquidity get taken out, price in the discount area, we can, and the top to the high time frame POI, we can go with the external point, which the target going to be right here. And yeah, as you can see, you are done for the day, right? You are done for the day. You can easily understand the market structure, the basic market structure that I told you, and follow that market structure to identify your range, and you can have the beautiful entry on those. And basically, the most important thing is just follow the liquidity, right? So here, it's going to be like this. Is focus on a high time frame, focus on the market structure in daily and the 4 hour time frame, right? These are going to be the time frame going to show you the liquidity, show you the break of market structure, going to show you the fake breakouts. Take a look to the daily time frame. A lot of traders went by here. The reason was this fake break of market structure, but for us, we know this is a sign of the reversal. Again, we have a sign of reversal here that in the 4 hour time frame pretty much get confirmed opposite shift and trend that we can understand we are in the bullish market structure, and you can easily identify your daily range and go with this one. This is a so much powerful concept. These were the concept that I personally use, and me and my student, as you can see in the win section, they are profitable, they are passing the prof frame, they are getting a payout, they are making money every day. But again, in the VIP, once you join a VIP, everything going to be much more clear for you because we dive into the advance of each of this and the It's going to be rule based. You're going to have a trading plan using this concept as a rule base. You can go with the scalp trading, you can go with the swing trading, you can go with the intraday trading, which is going to help you a lot. So now in the next lesson, I'm going to talk about the psychology, the risk management, and also you're going to have a channel as a trade breakdown that every week or every day I will going to do a trade breakdown for you using this concept, teaching you this stuff, and you can easily understand. And I hope you enjoyed it. Don't forget to take a note, practice a lot, and yep, see you in the next lesson.
If you're still here right now, I want to say something real. Most people didn't make this far. And not because of the video is long, but because long form learning requires patience. And patience is rare. You stayed, and that's already told me something about you. Trading doesn't fail people. People quit on trading. They quit before everything starts to make sense. And if you made it into end of this guide, you are not looking for shortcut. You are looking for understanding. This video didn't make you profitable. What it did was give you a structure. It gave you a way to look at a price without guessing every move. Trading is still going to be hard. You will still make mistakes. You will still have losing days that never disappears. What changed is you stop feeling lost. And that's the difference between a trader who survives and traders who quit. Some of you will take what you learn here and walk through the rest by your own, and that's completely fine. Others will want a structure, community, and support so they don't spend next few years guessing. If that's you, I will leave the next step below if you want. I don't work with everyone. I work with the people that they want to do the work, the same kind of the people that they made until end of this guidance. So wherever you are right now, starting, restarting, or rebuilding, you are on the right path. If you're going into 2026 serious about trading, comment below and let me know where you are at. I read more than you think. And if this guide was helpful for you, liking the video or subscribe will help other traders to find this too. I will see you in the next one. Cheers.